Welcome to our summary of The Intelligent Investor by Benjamin Graham, one of the most influential books on investing ever written. First published in 1949, this book has stood the test of time and remains relevant today for anyone interested in investing intelligently and avoiding speculation. He is widely regarded as the father of value investing, a philosophy that emphasizes the importance of buying stocks that are undervalued in relation to their intrinsic value. His approach to investing is grounded in fundamental analysis and a disciplined mindset, which he believed were essential for achieving long-term success in the stock market. The Intelligent Investor is a comprehensive guide to investing that covers a wide range of topics, from market fluctuations and stock selection to portfolio management and risk management. It's a book that's accessible to both novice and seasoned investors, offering practical wisdom and common sense advice for anyone looking to build long-term wealth through the stock market. In this video, we'll be taking a closer look at the key ideas and insights from The Intelligent Investor, exploring how his approach to investing can help you achieve your financial goals. Whether you're just starting out or looking to refine your investment strategy, The Intelligent Investor is a book you don't want to miss. So sit back, relax, and join us as we dive into this timeless classic. Here is a detailed summary of The Intelligent Investor. Chapter 1. Investment versus Speculation. In the first chapter of The Intelligent Investor, he discusses the difference between investing and speculation. He defines investing as the process of purchasing stocks with a margin of safety, meaning that the investor buys stocks that are undervalued in relation to their intrinsic value. In contrast, speculation involves buying stocks without any regard for their underlying value, with the hopes of making a quick profit. He argues that investing is a more reliable and sustainable way to build wealth over the long term, whereas speculation is a risky and unreliable way to achieve financial success. He also notes that many investors mistake speculation for investing, leading to poor investment decisions and significant financial losses. He provides examples of both investing and speculation, such as purchasing a well-established company with a history of profitability versus buying a new and untested technology stock. He notes that while both approaches can potentially yield profits, investing is a more prudent and reliable approach for the average investor. The chapter also discusses the role of emotions in investing, highlighting that many investors make decisions based on fear, greed, or other irrational factors. He argues that the best way to overcome these emotions is to adopt a disciplined and rational approach to investing, such as following a set of predetermined criteria for selecting stocks. Overall, the first chapter sets the stage for the rest of the book by emphasizing the importance of investing intelligently and avoiding speculation. He encourages readers to become informed investors who are knowledgeable about the market, able to evaluate investments critically, and focused on achieving long-term success rather than short-term gains. He notes that while investing may require patience and discipline, it ultimately offers a more reliable path to financial security than speculation. Chapter 2. The Investor and Inflation. In this chapter, Graham discusses the impact of inflation on investing. He notes that inflation can erode the purchasing power of money, which can have significant consequences for investors. Graham argues that investors must take inflation into account when making investment decisions and devise strategies to mitigate its effects. He provides historical examples of the impact of inflation, such as the hyperinflation in Germany after World War I, which rendered the German currency worthless. He notes that even in times of moderate inflation, the value of money can decrease significantly over time, which can affect investment returns. He emphasizes the importance of understanding the difference between nominal and real rates of return. Nominal rates of return are the actual rates of return earned on an investment, while real rates of return take inflation into account. He argues that investors should focus on real rates of return, as these provide a more accurate picture of investment performance. He also discusses the concept of purchasing power and notes that inflation can erode the purchasing power of both money and investments. He advises investors to focus on investments that have a strong track record of preserving purchasing power, such as high-quality bonds and stocks of established companies with a history of consistent earnings growth. Finally, he suggests several strategies for mitigating the effects of inflation, such as investing in assets that are likely to appreciate in value over time, such as real estate or commodities. He also advises investors to be wary of investments that promise high returns but have not historically kept up with inflation. Overall, Chapter 2 emphasizes the importance of taking inflation into account when making investment decisions. Graham's advice to focus on real rates of return and investments that preserve purchasing power remains relevant today, as inflation continues to be a major consideration for investors. Chapter 3. A Century of Stock Market History, the Level of Stock Prices in Early 1972. In this chapter, he presents a historical analysis of stock market performance over the previous century, with a focus on the level of stock prices as of early 1972. He argues that stock prices were overvalued at the time and that investors should exercise caution when making investment decisions. He notes that stock prices have historically followed a cyclical pattern, with periods of high prices followed by periods of low prices. He argues that the level of stock prices can be a useful indicator of future investment returns, as high prices are typically followed by lower returns and vice versa. He notes that as of early 1972, the stock market was in the midst of a period of high prices, which he believes were not justified by underlying economic conditions. He notes that the price-earnings ratio (P/E ratio) of stocks was higher than historical averages, indicating that investors were paying more for each dollar of earnings than they had in the past. He argues that investors should be cautious when stock prices are high, as the potential for future returns is lower. He advises investors to focus on buying stocks when they are undervalued and to be patient, as it may take time for stock prices to return to reasonable levels. Overall, Chapter 3 provides a historical perspective on stock market performance and emphasizes the importance of considering valuation when making investment decisions. Graham's warning about overvalued stock prices remains relevant today, as many investors continue to chase returns in a market that is often driven by hype and speculation. By focusing on value and exercising caution, investors can increase their chances of achieving long-term success in the stock market. Chapter 4. General Portfolio Policy, the Defensive Investor. In this chapter, Graham outlines a portfolio strategy for the defensive investor, or an investor who is primarily concerned with preserving capital rather than achieving high returns. He argues that defensive investors should focus on a combination of bonds and high-quality stocks in order to achieve a balance of safety and return. He recommends that defensive investors allocate their portfolios between 25% and 75% in bonds, with the remainder in stocks. He suggests that investors should focus on high-quality bonds with short to intermediate maturities, as these provide a reliable source of income with relatively low risk. For stocks, he recommends investing in large, well-established companies with a history of consistent earnings growth and strong financial positions. He emphasizes the importance of diversification in a defensive portfolio, noting that a mix of different asset classes can help to reduce risk and increase the likelihood of consistent returns. He also notes that defensive investors should be wary of speculative investments or those with high levels of risk, as these can lead to significant losses and undermine the goal of capital preservation. Finally, he notes that the defensive investor should avoid trying to time the market or make frequent changes to their portfolio. Instead, he recommends a buy-and-hold approach, where investors hold on to their investments for the long term and make adjustments only as needed based on changes in personal circumstances or market conditions. Overall, Chapter 4 provides a framework for a defensive investment strategy focused on capital preservation and a balanced mix of stocks and bonds. By diversifying across different asset classes and focusing on high-quality, low-risk investments, defensive investors can increase their chances of achieving consistent returns over the long term. Chapter 5. The Defensive Investor and Common Stocks. In this chapter, he expands on his discussion of defensive investing by exploring the role of common stocks in a defensive portfolio. He argues that while stocks are generally riskier than bonds, they can still play an important role in a balanced portfolio if selected and managed appropriately. He notes that the defensive investor should focus on high-quality stocks with a long history of consistent earnings and dividends. He recommends investing in large, well-established companies with a strong financial position and a competitive advantage in their industry. He also advises against investing in speculative stocks or those with a high level of risk. He discusses several methods for evaluating the value of a stock, including price-earnings ratios, dividend yields, and book value. He notes that investors should be wary of stocks with high P/E ratios, as these often indicate that the stock is overvalued. Conversely, stocks with low P/E ratios may be undervalued and represent a good investment opportunity. He also emphasizes the importance of diversification in a stock portfolio. He recommends that investors hold a mix of stocks across different industries and sectors, in order to reduce risk and increase the likelihood of consistent returns. Finally, he advises investors to be patient and avoid making frequent changes to their portfolio. He notes that stock prices can be volatile in the short term, but tend to follow a cyclical pattern over the long term. By holding on to high-quality stocks and avoiding speculative investments, investors can increase their chances of achieving long-term success in the stock market. Overall, Chapter 5 provides a detailed discussion of the role of common stocks in a defensive investment strategy. By focusing on high-quality stocks with a long history of consistent earnings and dividends, and by diversifying across different industries and sectors, defensive investors can achieve a balance of safety and return in their portfolio. Chapter 6. Portfolio Policy for the Enterprising Investor, Negative Approach. In this chapter, Graham discusses portfolio strategies for the enterprising investor, or an investor who is willing to put in the time and effort to analyze individual stocks and take on more risk in order to achieve higher returns. He argues that enterprising investors should take a more active approach to investing, but also emphasizes the importance of a disciplined, long-term strategy. He introduces the concept of a negative approach to investing, where investors start by eliminating stocks that do not meet certain criteria, such as a low price-earnings ratio or a history of consistent earnings growth. By using this approach, investors can focus on a smaller subset of stocks that are more likely to perform well over the long term. He also discusses the importance of diversification for enterprising investors. While they may have a higher tolerance for risk than defensive investors, they should still avoid investing too heavily in any one stock or industry. He suggests that enterprising investors should aim to hold at least 10-30 different stocks in their portfolio, spread across different industries and sectors. He also emphasizes the importance of a long-term outlook for enterprising investors. He notes that short-term fluctuations in the stock market can be difficult to predict, but that over the long term, stocks tend to follow a cyclical pattern. By holding on to stocks for the long term and avoiding frequent trading, investors can increase their chances of achieving consistent returns. Finally, he discusses the importance of discipline and patience in investing. He notes that successful investors are often those who are able to resist the temptation to follow the crowd or make impulsive decisions based on short-term market trends. By sticking to a well-defined strategy and remaining patient in the face of short-term fluctuations, enterprising investors can increase their chances of long-term success. Overall, Chapter 6 provides a framework for enterprising investors who are willing to take on more risk in order to achieve higher returns. By using a negative approach to eliminate stocks that do not meet certain criteria, and by diversifying across different industries and sectors, enterprising investors can increase their chances of success over the long term. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. In Chapter 7, Graham continues his discussion of portfolio strategies for the enterprising investor. In this chapter, he focuses on the positive side of investing, or the process of identifying stocks that meet certain criteria and are likely to perform well over the long term. He argues that the key to successful investing is to focus on stocks that are undervalued relative to their intrinsic value. He suggests that enterprising investors should focus on stocks that have a low price-earnings ratio, a high dividend yield, and a history of consistent earnings growth. By using these criteria to identify undervalued stocks, investors can increase their chances of achieving long-term success. He also suggests that enterprising investors should consider using a margin of safety when investing in stocks. A margin of safety is the difference between the intrinsic value of a stock and its market price. By buying stocks with a margin of safety, investors can protect themselves from potential losses if the stock price were to decline. He emphasizes the importance of thorough research when selecting individual stocks. He notes that enterprising investors should take the time to analyze a company's financial statements, management team, and competitive position in the market before making an investment. Finally, he discusses the importance of a diversified portfolio for enterprising investors. While the positive approach to investing focuses on identifying individual stocks that are likely to perform well, diversification across different industries and sectors can help reduce overall portfolio risk. Overall, Chapter 7 provides a detailed framework for enterprising investors to identify undervalued stocks with the potential for long-term growth. By focusing on stocks with a low price-earnings ratio, high dividend yield, and consistent earnings growth, and by using a margin of safety and conducting thorough research, investors can increase their chances of achieving success over the long term. Chapter 8. The Investor and Market Fluctuations. In Chapter 8, Graham discusses the impact of market fluctuations on the behavior of investors. He argues that investors are often driven by emotions rather than rational analysis, and that this can lead to poor decision-making. He suggests that investors should view market fluctuations as opportunities rather than threats. When prices are low, investors can purchase stocks at a discount, and when prices are high, they can sell stocks at a premium. By focusing on the long-term intrinsic value of a stock, rather than short-term price movements, investors can avoid making impulsive decisions based on emotions. He also notes that investors should be prepared for market fluctuations by establishing a sound investment policy. This policy should be based on the investor's financial situation, risk tolerance, and long-term investment goals. By establishing a clear investment policy, investors can avoid making hasty decisions based on short-term market movements. Additionally, he emphasizes the importance of maintaining a margin of safety when investing. A margin of safety provides a cushion against market fluctuations and helps protect investors from potential losses. Finally, he warns investors against trying to time the market or speculate on short-term price movements. He notes that trying to time the market is a risky strategy, and that investors who try to predict short-term market movements are likely to end up losing money. Overall, Chapter 8 provides valuable insights into the impact of market fluctuations on investor behavior. By focusing on the long-term intrinsic value of a stock, establishing a sound investment policy, maintaining a margin of safety, and avoiding speculative behavior, investors can increase their chances of achieving long-term success. Chapter 9. Investing in Investment Funds. In Chapter 9, he discusses the benefits and drawbacks of investing in investment funds, which are mutual funds and closed-end funds that offer investors the opportunity to diversify their portfolios. He notes that investment funds can offer investors several advantages, including professional management, diversification, and liquidity. Professional management can help investors avoid the pitfalls of emotional decision-making, and diversification can help reduce overall portfolio risk. Additionally, investment funds are generally more liquid than individual stocks, making it easier for investors to buy and sell shares. However, he also warns investors that investment funds can have drawbacks. He notes that investment funds typically charge fees, which can reduce the investor's returns. Additionally, some investment funds may be more focused on generating fees for the fund managers than on maximizing returns for the investors. He suggests that investors who are considering investing in investment funds should take the time to research the fund's management team, investment philosophy, and track record. Additionally, investors should carefully review the fund's fees and expenses, and compare them to the returns that the fund has generated in the past. He also notes that investors should consider the tax implications of investing in investment funds. Some investment funds may generate higher taxes than individual stocks, depending on the fund's investment strategy and the investor's tax bracket. Overall, Chapter 9 provides valuable insights into the benefits and drawbacks of investing in investment funds. While investment funds can offer investors diversification, professional management, and liquidity, investors should also be aware of the fees and expenses associated with these funds, as well as the tax implications of investing in them. By carefully researching investment funds and comparing them to individual stocks, investors can make informed decisions about how to allocate their investment portfolios. Chapter 10. The Investor and His Advisors. This chapter focuses on the relationship between investors and their advisors, including brokers, financial planners, and other professionals who offer investment advice. The chapter begins by discussing the importance of choosing a trustworthy and knowledgeable advisor. He advises investors to seek out professionals who have a good reputation and a track record of success. He also warns against advisors who promise high returns or use high-pressure sales tactics. He then goes on to discuss the different types of advisors and their roles. Brokers, for example, are primarily focused on executing trades and may not offer comprehensive investment advice. Financial planners, on the other hand, often provide more comprehensive advice on a range of investment topics. He also discusses the potential conflicts of interest that can arise when investors work with advisors. For example, advisors may receive commissions or other incentives for recommending certain products or services. This can lead to bias and may not always be in the investor's best interests. To mitigate these conflicts of interest, he advises investors to be clear about their investment goals and to seek out advisors who are transparent about their fees and compensation. He also encourages investors to do their own research and not to rely solely on the advice of others. Overall, Chapter 10 of The Intelligent Investor provides valuable insights into the role of advisors in the investment process. Graham emphasizes the importance of finding a trustworthy and knowledgeable advisor while also being aware of potential conflicts of interest. By taking a thoughtful and informed approach to working with advisors, investors can make more informed decisions and achieve greater success in their investments. Chapter 11. Security Analysis for the Lay Investor. In this chapter, Graham explains the principles of security analysis and how individual investors can use them to evaluate potential investments. He begins by emphasizing the importance of understanding the fundamentals of a company before investing in its stock. He encourages investors to focus on the company's financial statements, including its balance sheet, income statement, and cash flow statement. By analyzing these statements, investors can gain a better understanding of the company's financial health and its prospects for future growth. He also discusses the importance of valuing a company's stock based on its intrinsic value, which is determined by the company's earnings power and growth potential. He cautions against using market price alone as a measure of a stock's value, as this can lead to overvaluation or undervaluation. To determine a company's intrinsic value, he recommends using a formula that takes into account the company's past earnings, expected future earnings, and the required rate of return. This approach, known as the dividend discount model, can provide a more accurate estimate of a company's true value. He also discusses the concept of margin of safety, which refers to the difference between a stock's intrinsic value and its market price. By investing in stocks that are selling at a significant discount to their intrinsic value, investors can minimize their risk of loss and potentially earn higher returns. Overall, Chapter 11 of The Intelligent Investor provides a comprehensive overview of security analysis for individual investors. Graham emphasizes the importance of understanding a company's financial statements and valuing a stock based on its intrinsic value, rather than relying solely on market price. By applying these principles and using a margin of safety, investors can make more informed investment decisions and potentially achieve greater success in the stock market. Chapter 12. Things to consider about per-share earning. In this chapter, Graham explains the importance of understanding a company's per-share earnings and how to evaluate them properly. He begins by explaining that per-share earnings are a key indicator of a company's profitability. However, he cautions investors against relying solely on this metric to evaluate a company's financial health. He notes that per-share earnings can be manipulated by accounting practices and may not always provide a complete picture of a company's profitability. To evaluate per-share earnings properly, he recommends looking at a company's earnings over a longer period of time, rather than focusing solely on its most recent earnings report. He also suggests comparing a company's earnings to its book value, or the value of its assets minus its liabilities. By doing so, investors can gain a better understanding of a company's overall profitability and financial health. He also discusses the importance of considering a company's dividend payout ratio when evaluating per-share earnings. The dividend payout ratio measures the percentage of a company's earnings that is paid out in dividends to shareholders. By comparing a company's dividend payout ratio to its earnings growth rate, investors can determine whether the company is reinvesting earnings for future growth or distributing them to shareholders. Finally, he emphasizes the importance of considering a company's price-to-earnings P/E ratio when evaluating per-share earnings. The P/E ratio measures a company's stock price relative to its per-share earnings. By comparing a company's P/E ratio to its historical average or the average P/E ratio of other companies in the same industry, investors can determine whether the stock is undervalued or overvalued. Overall, Chapter 12 of The Intelligent Investor provides valuable insights into the proper evaluation of per-share earnings. He emphasizes the importance of looking at a company's earnings over a longer period of time, comparing earnings to book value and dividend payout ratio, and considering the P/E ratio when evaluating per-share earnings. By taking a comprehensive approach to evaluating per-share earnings, investors can make more informed investment decisions and potentially achieve greater success in the stock market. Chapter 13. A comparison of 4 listed companies. In this chapter, Graham provides a detailed analysis of 4 companies: American Can, Anaconda Copper, General Motors, and Texas Company. He compares and contrasts their financial statements and stock valuations to illustrate key principles of value investing. He begins by noting that the 4 companies differ in terms of their size, industry, and financial performance. He then provides a detailed analysis of each company's financial statements, including their balance sheets, income statements, and cash flow statements. By analyzing these statements, he identifies trends and patterns in each company's financial performance, such as their revenue growth, profit margins, and cash flow generation. He then discusses each company's stock valuation using metrics such as price-to-earnings P/E ratio, price-to-book P/B ratio, and dividend yield. He notes that each company's valuation varies based on a variety of factors, such as their industry, growth potential, and financial health. He also emphasizes the importance of using a margin of safety when evaluating stocks, which means buying stocks at a significant discount to their intrinsic value to minimize the risk of loss. Through his analysis of these 4 companies, he illustrates key principles of value investing, such as the importance of understanding a company's financial statements and using metrics such as P/E ratio, P/B ratio, and dividend yield to evaluate stocks. He also emphasizes the importance of using a margin of safety to minimize the risk of loss and achieve greater returns over the long term. Overall, Chapter 13 of The Intelligent Investor provides a valuable case study of 4 companies and their financial performance, offering insights into key principles of value investing and how to apply them to stock analysis. By following Graham's example and conducting a thorough analysis of companies' financial statements and stock valuations, investors can make more informed investment decisions and potentially achieve greater success in the stock market. Chapter 14. Stock Selection for the Defensive Investor. In this chapter, Graham provides guidance for conservative, long-term investors who are primarily interested in preserving their capital and achieving reasonable returns with low risk. He begins by explaining that defensive investors should focus on high-quality, established companies with a long track record of stable earnings and dividends. He suggests looking for companies with a strong financial position, such as a low debt-to-equity ratio and a history of consistent profitability. He also emphasizes the importance of diversification, recommending that investors hold a portfolio of at least 10-30 stocks in different industries to minimize risk. He notes that defensive investors should focus on long-term, low-cost investing strategies, such as index funds or dividend reinvestment plans (DRIPs). In terms of stock selection, he suggests using a set of criteria to identify promising stocks. He recommends looking for stocks with a P/E ratio below the market average, a dividend yield of at least 2/3 the AA bond yield, and a price-to-book P/B ratio below 1.5. He also suggests looking for companies with a long-term history of earnings and dividend growth, as well as a stable or increasing profit margin. He notes that defensive investors should avoid speculative stocks, such as those with high P/E ratios or unproven business models. He also recommends avoiding companies and industries that are prone to significant changes or technological disruption. Overall, Chapter 14 of The Intelligent Investor provides valuable guidance for conservative, long-term investors who are primarily interested in preserving their capital and achieving reasonable returns with low risk. Graham emphasizes the importance of focusing on high-quality, established companies with a strong financial position and a long-term history of stable earnings and dividends. By following Graham's advice and using a set of criteria to identify promising stocks, defensive investors can build a diversified portfolio of low-risk, high-quality stocks and potentially achieve long-term success in the stock market. Chapter 15. Stock Selection for the Enterprising Investor. In this chapter, Graham provides guidance for investors who are willing to put in the time and effort to actively manage their portfolios and are willing to take on more risk to potentially achieve higher returns. He begins by noting that enterprising investors should focus on undervalued or out-of-favor stocks that have the potential to generate higher returns over the long term. He suggests looking for stocks that are trading below their intrinsic value, which can be calculated using a variety of methods such as discounted cash flow analysis or price-to-earnings growth PEG ratio. He also emphasizes the importance of diversification, recommending that investors hold a portfolio of at least 10-30 stocks in different industries to minimize risk. He notes that enterprising investors should focus on active, value-based investing strategies, such as buying stocks with low P/E ratios or high dividend yields. In terms of stock selection, he suggests using a set of criteria to identify undervalued stocks. He recommends looking for stocks with a low P/E ratio, a high dividend yield, a low price-to-book P/B ratio, and a high earnings growth rate. He also suggests looking for companies with a strong financial position and a competitive advantage in their industry. He notes that enterprising investors should be willing to take on more risk and invest in smaller or less well-known companies that have the potential for high growth. However, he warns against investing in speculative or highly volatile stocks, such as those in emerging industries or with unproven business models. Overall, Chapter 15 of The Intelligent Investor provides valuable guidance for enterprising investors who are willing to put in the time and effort to actively manage their portfolios and take on more risk to potentially achieve higher returns. Graham emphasizes the importance of focusing on undervalued or out-of-favor stocks with strong financial positions and competitive advantages. By following Graham's advice and using a set of criteria to identify undervalued stocks, enterprising investors can build a diversified portfolio of high-quality stocks and potentially achieve long-term success in the stock market. Chapter 16. Convertible Issues and Warrant. In this chapter, Graham discusses two types of securities that have elements of both stocks and bonds: convertible bonds and warrants. He begins by explaining that convertible bonds are bonds that can be converted into a specified number of shares of the issuing company's stock. He notes that convertible bonds typically offer a lower yield than regular bonds, but provide the potential for capital appreciation if the stock price rises above the conversion price. He suggests that investors should only consider investing in convertible bonds if they have a high degree of confidence in the company's long-term prospects. He also discusses warrants, which are similar to options and give the holder the right to purchase a specified number of shares of the issuing company's stock at a set price. He notes that warrants typically have a longer term than options and can provide a high degree of leverage if the stock price rises above the exercise price. However, he warns that warrants can be highly speculative and should only be considered by sophisticated investors who are willing to take on more risk. He emphasizes that investors should approach convertible issues and warrants with caution and carefully consider the terms of each security before investing. He notes that convertible bonds and warrants can be complex and difficult to value, and may require a thorough analysis of the issuing company's financial position and growth prospects. Overall, Chapter 16 of The Intelligent Investor provides valuable guidance for investors who are considering investing in convertible bonds or warrants. Graham emphasizes the importance of carefully evaluating the terms of each security and considering the long-term prospects of the issuing company. By approaching convertible issues and warrants with caution and conducting a thorough analysis, investors can potentially achieve long-term success in the stock market. Chapter 17. 4 Extremely Instructive Case Histories. In this chapter, Graham provides 4 case studies of stocks that were popular with investors but ultimately proved to be disastrous investments. The first case study is of Northern Pipeline Company, a Canadian stock that was widely recommended by investment advisors in the early 1920s. Despite a lack of profitability and a questionable financial position, the stock price rose to over $70 per share before collapsing to less than $1 per share during the Great Depression. He notes that the Northern Pipeline Company serves as an example of the dangers of investing in highly promoted stocks without a thorough analysis of the company's financial position and growth prospects. The second case study is of Goldman Sachs Trading Corporation, a closed-end fund that invested in highly speculative securities during the 1920s. The fund was highly leveraged and eventually collapsed in 1929, wiping out the investments of thousands of investors. He notes that the Goldman Sachs Trading Corporation serves as a cautionary tale about the dangers of investing in highly speculative funds with high leverage. The third case study is of American Company, a widely held stock that was highly profitable in the 1920s but ultimately suffered from intense competition and declining margins. Despite warning signs, many investors held onto the stock until it had lost over 90% of its value. He notes that the American Company serves as an example of the dangers of investing in highly profitable companies without a thorough analysis of the company's competitive position and potential risks. The final case study is of Aluminum Company of America Alcoa, a highly regarded and profitable company that was widely held by investors in the 1950s. Despite a strong financial position, the stock price declined by over 50% due to increased competition and declining profits. Graham notes that Alcoa serves as an example of the dangers of investing in a highly regarded company without considering potential risks and future growth prospects. Overall, Chapter 17 of The Intelligent Investor provides valuable insights into the dangers of investing in highly promoted stocks, highly speculative funds, highly profitable companies without considering potential risks, and highly regarded companies without considering future growth prospects. By analyzing these case studies, investors can learn important lessons about the importance of conducting a thorough analysis and understanding potential risks before investing in any stock or fund. Chapter 18. A comparison of 8 pairs of companies. In this chapter, Graham provides a detailed comparison of 8 pairs of companies in similar industries, analyzing their financial performance and highlighting the differences in their stock market valuations. He begins by noting that investors often make the mistake of focusing solely on a company's growth prospects, without considering its financial position and the risks associated with its business. He emphasizes the importance of analyzing a company's financial statements, including its income statement, balance sheet, and cash flow statement, in order to gain a thorough understanding of its financial position and growth potential. He then proceeds to compare 8 pairs of companies, including General Electric and Westinghouse Electric, Coca-Cola and PepsiCo, and General Motors and Ford. He analyzes each company's financial statements, including its sales, earnings, dividends, and book value, and compares their stock market valuations, including their price-to-earnings P/E ratio, price-to-book P/B ratio, and dividend yield. Through these comparisons, he highlights the importance of considering a company's financial position and growth prospects when investing in its stock. He notes that some companies may have higher growth prospects but lower financial stability, while others may have lower growth prospects but higher financial stability. By analyzing a company's financial statements and comparing it to its peers, investors can gain a better understanding of its financial position and growth potential, and make more informed investment decisions. Overall, Chapter 18 of The Intelligent Investor provides valuable insights into the importance of analyzing a company's financial position and growth prospects when investing in its stock. By comparing 8 pairs of companies, Graham highlights the differences in their financial performance and stock market valuations, and emphasizes the need for investors to conduct a thorough analysis before investing in any stock. Chapter 19. Shareholders and Management's Dividend Policy. In this chapter, Graham discusses the relationship between shareholders and management, particularly with regard to the payment of dividends. He begins by noting that shareholders are the owners of a company, and as such, they have a right to share in the profits of the company. He argues that companies should prioritize the payment of dividends to shareholders, as this is a tangible way of sharing the profits with them. However, he also acknowledges that management may have other priorities, such as reinvesting profits into the business for growth or paying off debt. In these cases, management may choose to pay lower dividends or no dividends at all. He then explores the different types of dividend policies that companies may adopt, including the stable dividend policy, the constant payout ratio policy, and the residual dividend policy. He notes that each policy has its advantages and disadvantages, and that the best policy will depend on the specific circumstances of the company. He also discusses the role of dividend yield in stock selection, noting that high dividend yields may be a sign of undervaluation or financial distress, while low dividend yields may be a sign of high growth potential. He encourages investors to consider a company's dividend policy as one factor in their investment analysis, but not to rely on it exclusively. Finally, he discusses the importance of shareholder activism in promoting good corporate governance and responsible dividend policy. He encourages shareholders to hold management accountable for their actions and to use their voting rights to advocate for policies that align with their interests. Overall, Chapter 19 of The Intelligent Investor provides a comprehensive overview of the relationship between shareholders and management, particularly with regard to dividend policy. Graham emphasizes the importance of prioritizing the payment of dividends to shareholders, while acknowledging that management may have other priorities as well. He encourages investors to consider a company's dividend policy as one factor in their investment analysis, and to advocate for responsible corporate governance through shareholder activism. Chapter 20. Margin of safety as the central concept of investment. In this chapter, Graham introduces the concept of margin of safety and argues that it is the most important principle for investors to follow. He defines margin of safety as the difference between the price of a stock and its intrinsic value. In other words, it is the cushion that protects investors from the possibility of losing money if the stock's price falls. He emphasizes that investors should always look for a margin of safety in their investments, and should only purchase stocks when they are available at a significant discount to their intrinsic value. This approach, he argues, helps to minimize the risk of losing money and maximizes the potential for long-term gains. He also notes that calculating the intrinsic value of a stock is not an exact science, and that different investors may come up with different valuations based on their own assumptions and methods. However, he argues that by using conservative estimates and being mindful of the limitations of their analysis, investors can increase the likelihood of achieving a satisfactory margin of safety. He further emphasizes that margin of safety is not only relevant for individual stock selection, but also for portfolio management. He recommends that investors diversify their portfolios across a variety of stocks and asset classes, in order to further minimize the risk of loss. Finally, he notes that the concept of margin of safety is not limited to stock investing, but can be applied to all areas of life. By seeking a margin of safety in all of their endeavors, individuals can protect themselves against unexpected setbacks and increase their chances of success. Overall, Chapter 20 of The Intelligent Investor emphasizes the importance of margin of safety as the central concept of investment. Graham encourages investors to always look for a margin of safety in their investments, to be mindful of the limitations of their analysis, and to diversify their portfolios in order to further minimize risk. By doing so, investors can increase their chances of achieving long-term success in the stock market and beyond.